Why pay more for your precious metals from the big guys with offices on Wall Street and who bank with JP Morgan? Get your fizz from the doc at SDBullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, with gold and silver both down hard Friday, continuing their post-FOMC taper normalization or QE normalization announcement on Wednesday. Here on Friday, big news, silver plunging below support found in June of 2013 to new bear market lows in the 17s. Gold down to around 12.15 on the day. We thought who better to invite back on the show than our good friend Alasdair Macleod. It's great to have you back, Alasdair.
That's my pleasure, Doc.
Well, let's get right into the trading action here. What's your take, Alasdair? I guess my fears here with silver breaking below 18, that if we don't see some strong buying in Asia as it opens Sunday, what we've seen in the past is further smashes on the Globex open Sunday night, and I think we could be at risk for that. Really, the next major support for silver is not into the 16 to 17 range. We kind of have a gap here up above 17. I guess we'll start out with your take on the short term, Alasdair. Is the pain over, or what do you see?
Well, in the very short term, I note the coincidence of this market move with the end of the quarter. If you think back, it's the quarter end that is the danger time for precious metals. It was at the end of last year. It was in June last year as well, in 2013. At those times, gold bottomed out, did a double bottom at about $1,180 something. It looks like it's being pushed down towards the end of the quarter back to try and break that level. And I think that's short term what it's about. It's about making everybody bearish about the metals. Why? Because bankers' bonuses depend on the profits on the book, and the profits on the book depend on mark-to-market at the quarter end. So that's my short-term analysis. But interestingly, behind that, the value boys, the people who see value in precious metals and assess their value for what it's worth, rightly or wrongly, are actually buying silver. We see at Gold Money that we've got demand for silver on a daily basis, net demand. It's not the case in gold. That's really sort of more big boy stuff, perhaps, but it's certainly true in silver. So I think if you put those two things together, we can see that silver is undervalued. That's what the buying in the physical is telling us. And my analysis also confirms that. And we're seeing quarter-end influences, and I hope they get squeezed very badly. That's all I can say, and I think that's actually quite a likely outcome.
And Eric, I'll get your take here. I know you and I have both thought for a while that 18 would hold as the bottom, but that wasn't the case here.
Yeah, well, on a closing basis, we're above, but it'll remain to be seen what happens on Sunday going into Monday, as you were talking about before. Backing up a step and reflecting on what Alasdair just spoke of, the end of the quarter period is really important, and if you look at various markets, you can see inflection points happening around that time as we're coming into the end of September, and it looks like, frankly, the management of all markets were working in tandem to deal with the ratcheting up of the management of perspective economics, the rhetoric, the jawboning coming out of the Fed when it comes to their attempt to regain their credibility by talking a good game about higher interest rates and normalization and all these things. In preparation for all of that talk, if you go towards the end of last month, you saw the bottoming out of the 10-year Treasury bond, and it dropped to a yield of below 2.3% on an intraday basis. And ever since we've been in September, we've shot back to on an end-of-day basis today, closing at 2.63% yield, and that's a pretty big move in less than a month. And if you look at the bigger picture, it's pretty clear that the powers that be came in mid-July, and we were within a 24-hour period of a total breakout in silver. And when we failed to get much over 22, that's when the whole painting of the tape started in earnest, and we've been through this whole process leading up to today. And it was beautiful to watch, frankly. I mean, the powers that be have done a masterful job painting all markets and managing expectations for people. And this whole cycle that we're in right now with these new lows in silver and gold, silver is now testing 4-year lows. It was all, a product of advanced preparation for this effort to convince people that normalization of interest rates is going to happen. The bottom line, though, is that interest of foreigners in U.S. debt remains lackluster, and even though the dollar is doing well relative to other currencies and the bond market has caught a bid and all of this stuff, the reality is that there aren't enough bond buyers out there for the U.S. government to finance its debt, and this whole tapering nonsense is more illusion than not, because we've seen in the case with Belgium buying earlier this year, and now they're hiding how the buying is going on. But the derivative complex in total is really where the government is manufacturing synthetic demand for treasury debt. And that's why gold and silver have to be taken to the slaughter. And we're just seeing that now. It's depressing to watch, but fundamentals are still there for much higher prices, and it's just a question of when, not if, they actually materialize. And on a momentum basis, the level of the suppression in the last month has been so severe that we probably will see some short covering in the not-too-distant future. But it'll be a question as to whether or not we get through the whole month without seeing that, because, again, that end-of-quarter tape painting is very, very important, and Alasdair's spot on for pointing that out.
And then the other thing from a timing perspective that's more than a bit suspective is we have today, here on Friday, the U.S. IPO of Alibaba, which at one point during trading today had a market cap that surpassed Walmart. And just anecdotally, my in-laws were over last night, and they were trying to get coins out of the couch and liquidate assets everywhere, because everyone all over MSN and all the CNBC and all the mainstream media has been apparently hyping it so much that mom and pop average Joe retiree investor that knows nothing about finances were coming up with assets anywhere they could for this Alibaba IPO. And then also we have the Shanghai Gold Exchange, which moved forward their international gold trading platform, which was originally scheduled to debut on September 29th, that ended up being pushed forward and went live yesterday on Thursday, the 18th. And we'll get your take here in a second, Alasdair, on the Shanghai Gold Exchange trading platform going live and the implications that might have on the market. But I just wanted to take a quick moment here and read a quote that legendary gold trader Jim Sinclair sent out to investors today on the trading. He advised that today is a day that should be memorized, and he said this is a classic example of popular delusions and the madness of the crowd, referring to the combination of the Alibaba IPO and the gold and silver takedown. And he's of the belief that we are highly likely to make a major cyclical change right here and now. He believes the gold long-term cycle has turned up and is now trading into major support. So with kind of that as a perspective, what is your take, Alasdair, on the Shanghai Gold Exchange? And again, more of a medium to long-term outlook here for the metals.
Well, the Shanghai Gold Exchange is being completely ignored in Western markets. I mean, very quietly, it has become the biggest physical exchange in the world, by far overtaking London. And this is no accident. This is a deliberate act of policy by the Chinese government. That China basically wants to control the gold market. And she has now got so much gold, and has had for some time, that she feels comfortable in encouraging her citizens to buy gold as well, so that her economy in the future has an insurance against the collapse of Western paper currencies, because the collapse of Western paper currencies will basically take out every currency. And I think that's broadly the game plan behind why China is so keen on controlling the gold market. The extension of the Shanghai Gold Exchange into the free trade zone, so that foreign banks can freely trade without having to, if you like, get the official imprint from onshore government to deal in the onshore market and this is an interesting point, I'll come back to that in a second, but the fact that they've opened this market up as a separate parallel market to overseas or non-Chinese banks, I find very interesting. It is a natural step in getting the physical gold market to gravitate even more towards China, and offshore China in this case. You might ask the question, why don't they just open up the onshore Shanghai Gold Exchange to foreign banks? There are a number of foreign banks who are members, but that market is actually quite closely controlled. And I think that the reason that they are separating out the two markets into a sort of free trade zone and the domestic market is they want to continue to keep control over the domestic market. The reason this is important is that we know at Gold Money from our refiners and also from our vaulting companies, we've got vaulting, we use vaulting facilities in Hong Kong, so our guys there are very close to the market. They never see 1 kilogram 4/9 purity Chinese refined bars. There are lots of bars, 4/9, 1 kilogram done by the Swiss and various others, but out of the Chinese government-controlled refiners, nothing. Now this tells me that China actually retains all her own gold production. When I say China, I mean the Chinese government in one form or another. Not only that, but bear in mind that all the scrap recycling, which last year I think is estimated to be something like 150, 200 tons, something like that, gets exactly the same treatment. So what we see going through the Shanghai Gold Exchange is on top of what is undeclared from China's own mine production, her scrap recycling, and to that I also ought to add the doré that is imported from abroad, paid for through the banking system maybe, but refined by government-owned refiners. That also all goes into the Chinese government's hands. So when you bear in mind that all around Africa, there are Chinamen rushing around, doing commodity deals. I've just had reasons to deal with firm stockbrokers in Lusaka, which is the capital of Zambia, and Zambia is one of the largest copper mining countries in the world. If you ring through to Zambia and you find that lines are engaged, you get a message in English and you get a message in Chinese. So you can see that the Chinese actually are in the process, and have been doing this for some time, of sewing up resources and gold coming out of Africa. So one way and another, this is all part of a policy basically to wrest control of the gold market from the West. And why we sit here and ignore it, quite frankly, is beyond me. Why the bullion banks just ignore it is beyond me. But I think the answer, in a sense, actually I don't want to go on too long about this, but I think the answer, in a sense, is that people in the West are so bearish about commodities and gold and silver that they feel there is absolutely no pressure on them to regularize their positions. They are continuing to run short positions because they look forward into the future and see nothing but continuing bear market. They're chasing the trend. And the problem with gold in particular is you don't have a yield to value it on. You can't say that there's going to be an internal rate of return of this under this assumption or that assumption. So the Warren Buffetts of this world can't buy it because they can't do that sort of analysis. But if you do understand the gold market and you look at the price of gold relative to the quantity of currency that is being produced, both in the form of hard, narrow money and also broader bank credit, you can see that actually gold is just getting so incredibly cheap. And I think that the other aspects of pricing gold is that, if anything, it's reflecting a shift of risk away from markets as a whole. I think that the big banks, they see the markets being controlled in effect by the Fed and other central banks. And bear in mind, you've got central banks, you've got government-controlled pension funds, you've got exchange stability funds, you've also got sovereign wealth funds. Those four categories of government-controlled funds around the world have something like $30 trillion equivalent at their disposal. They can rig this market long after you and I are dead, in theory anyway. So that's what's going on. And if that is the case, then, and you're a bullion bank, you probably take the view, we'll just stay short of this one. We'll talk it down because there is no investor interest. Now, of course, all that changes when a crisis occurs. And I think that crisis actually could be just around the corner. But that's a slightly different story and is getting off the topic of the question.
Fair topic nonetheless, I would suspect. So what would you speculate as far as what your favorite black swan of the week would be?
Well, I mean, one thing that I'm watching very closely is the way various economies are going. And if you look at Japan, I mean, what's fascinating about that is that Abenomics relies very heavily on the most aggressive form of quantitative easing you can possibly imagine. They have increased the size of the balance sheet very, very dramatically, for the Bank of Japan, that is. That's increased very dramatically. Now, has this rescued the economy? Has it? Hell is like. The economy has just nosedived. The trade deficit has got considerably worse. People are reducing their spending. It is now contracting in spite of all this extra money being injected into the system. Now, to understand actually what QE is about is I've just given you the official story as to why QE is there, and that is to help the economy recover. It's demonstrably fails in doing that. What we have instead is a means of printing money, calling it something else, but printing money so that governments can finance their deficits. And that essentially is what's happening in Japan. And it's such a stark, clear example that we need to watch what's going on there in order that we understand what quantitative easing is elsewhere and what quantitative easing in Europe is likely to be about as well at some stage. Quantitative easing is about financing government deficits. And in Japan's case, she has savers who, up until now, were increasing their saving pots and therefore had the, if you like, the monetary wherewithal to buy more new government debt. Now those savers are withdrawing their savings from the market. They're spending them because they're now old. The retired element in Japanese society is absolutely enormous. I think there was an American who pointed out that they sell more diapers for the elderly than they do for children in Japan, and that is a measure, if you like, of the crisis that they have got, the demographic crisis that they're in. So if their savers are now spending their savings, then government cannot finance its growing deficit, so it has to print the money. That is why QE is there in Japan, and it is as simple as that. And, every way you look at it, you come up with that conclusion. And this, I'm afraid, is something that governments who can print money always do, and they always end up destroying their own currencies. We are doing the same in Europe now. Mr. Draghi is trying to encourage the banks to borrow money off the central bank. That is not working. There was a very disappointing take-up on this offer on Thursday. So this might bring forward the day when they do full-blown QE. Now, all the economists, mainly Keynesian economists, expect this to happen, and they would argue that this must happen in order to rescue the Eurozone from a deflationary slump. I won't go into the dynamics of that, but what you have with QE is something that demonstrably does not get economies recovering. So, if you look at the bond markets now, in the Eurozone and in America, the governments don't have a problem funding themselves. The yields in America, I think you mentioned earlier, 10-year treasuries, 2.63%, having been down to about 2.3%. That's not a problem for a government funding. I think the 30-year is something like 3.6, 3.7%, something like that. That is extremely cheap funding. So they don't need QE anymore. And I think the reason that the Fed tapered QE is quite simply because the government borrowing program didn't need the support of printed money. So they start withdrawing it. We have the same situation in essence in Europe, where the Spanish debt, the 10-year debt, is around about 2.5%. Italian debt, exactly the same. This is incredibly low. They are wildly mispriced, these markets. I mean, nobody in their right mind would lend money to an Italian or Spanish or Portuguese government for 10 years for anything like 2 or 3% interest. I mean, it's completely nonsensical. So the markets, these bond markets, are wildly mispriced. Now, what this means is that when normality returns to these markets, and at some stage they will, probably when we least expect it, then governments are going to have a funding cost which is beyond their capability to pay. So what do we do in that case? Then what we do is we get QE going again. But how are you going to persuade people to accept QE when it is now quite clearly the mechanism by which governments fund their deficits, and it's not the mechanism which helps the economy recover? So when you ask, where is the black swan event, I think that it's really tied up in the dynamics of that situation, the relationship between what the central banks are doing with printing money, governments' demands for funding their deficits, and the last thing these politicians are doing is actually sort of thinking we ought to cut our spending. And the fact that the debasement of the currency, if I can put it this way, is a huge, great burden on the economy, which is not being recognized by the economists. But it is a huge, great burden on the economy. And the result is that it's QE itself which is tending to drive the economy into a slump. And that is the lesson we're also getting from Japan. So, black swan event, I think, is around those three dynamics. I hope I've made that reasonably clear, but it's quite a complex issue.
Well, I mean, it's clear that the economies around the world are slowing markedly, and that is the tale of the tape, that the governments do, in fact, need quantitative easing, even in the short term, to keep interest rates where they are. And this movement that we have seen in the 10-year in the United States is a perfect indication of that. I mean, it's up at like a 75, 80-degree angle in terms of like a near hockey stick move in September for the 10-year. And it remains to be seen what is going to happen when the 10-year tests 3%, because that line in the sand has been something that's been defended very aggressively before. But it's almost as if the powers that be are speaking on the one side of their mouth about how the economy is doing well, inflation remains anchored, our expectations for inflation remains anchored, yet at the same time there is this expectation of the global economy slowing to the point where there can be some kind of a stimulus in the future. I mean, I have to assume that that's what's in the back of the minds of all the various central bankers around the world.
Well, I mean, what the central bankers think, I think, is a very interesting question, because Jamie Caruana, who's the head of the Bank for International Settlements, wrote an opinion piece in the Bank for International Settlements Journal about 3 months ago, cautioning about the dangers of monetary expansion. Now, this from the head of all the central banks was really, I think, quite remarkable. And to me, it is indicative that there are doubts creeping in the minds of senior central bankers about the efficacy of quantitative easing and expansionary monetary policies when it comes to rescuing the economy or kickstarting growth, or however you like to put it. But the problem they have is that having set off on this path, they can't really withdraw from it. I mean, do they turn around to their politicians and say, sorry, printing press is shut? No. Do they allow interest rates to find their natural level, which, given the amount of malinvestments in the economy, I would suggest is quite a bit higher than zero? Well, no, because everybody's so geared that that would immediately bankrupt very large portions of industry, and individuals, indeed, who are over-leveraged on their house mortgages and credit card debt and Lord knows what. I mean, they're stuck into this course from which there is now no escape. They are in a debt trap, and allowing interest rates to rise just brings on death, if you like. In that sense, I was interested you bringing up the very recent rise in the in Treasury bond yields, because If that continues very much more, this actually could generate a bit of a crisis, I think, in terms of companies that need to fund their operations. Indebted companies, they're going to find that suddenly the world has become a lot less friendly, and they're going to have to cut back and in some cases even go bust.
Well, I wanted to change gears a bit here. I know you had mentioned earlier in the show, Alasdair, about the demand you've been seeing at gold money for silver over gold, with the big boys haven't been taken down quite as much. And I can say that we've been seeing the same thing here at SDBullion. While gold sales have remained steady over the second half of this week, really beginning on Wednesday with the FOMC release and the initial kind of leg down, and then continuing down into Thursday, and then really escalating into Friday. At SDBullion, we've been, I guess the best way to put it is drowning in silver orders, and we're seeing that across the wholesale market in general here in the U.S. Silver shortages have popped up on freshly minted products in both the bar and round form. The Sunshine Mint for both their bars and their rounds, they're about 4 weeks out for new orders from dealers. And premiums are starting to rise on 90% silver. And as we were kind of chatting before the show, I fully expect that if we do see any further decline on the Sunday night Globex session, as we've been accustomed to seeing on drops down like this, look for premiums across the board to begin to rise a decent amount here next week, just from what we've been seeing in the wholesale physical market. The retail silver demand has reawakened with a roar, and it's been quite something to see.
That's interesting. And the other thing which I think is worth noting is the level of open interest on COMEX in silver is pretty well at record levels.
With 5 days, five trading days to go, we're at, what is it, the second highest open interest other than, I want to say, was it May of 2013?
Yeah, I mean, I think we've been over 172,000 contracts, which I think is the highest for the last, I don't know how far back, I'm not too sure, but that is exceptionally high. So where is this ownership coming from? I think that to an extent you've got industrial users who are locking in these low prices because they are very attractive for their manufacturing margins. But if you think back to 2 years ago, and you were, let's say, making solar panels, in your business plan you probably wrote in an estimate for the price of silver averaging something like $40 an ounce. And you probably planned forward into 2014-15 at a price maybe even, well, the same or even perhaps a bit higher. And now we find that it's $17, $18, $19. At that levels, you really, if you're running a business making solar panels or whatever it might be, then you're going to go out and you're going to hedge the price in the market by buying futures contracts. You're not really price sensitive to the sort of moment-to-moment vagaries of market emotion. All you're doing is you're saying, my goodness, we're going to turn in a nice profit this year. If I can lock it in at $21 or 20, or how wonderful if it even goes down to 18. I mean, think of the profits we're going to lock in here. So having looked at and tried to follow these commitment of traders figures very closely, that is the conclusion I come up with. And interestingly, you don't get the same pattern in gold at all. The level of open interest in gold is not exceptional. I would say, if anything, it's probably slightly down on an average taken over a period of time. So there's nothing remarkable about the situation in gold, but silver is really noticeable in that respect. And I think that tells us that, bashing the price as they have done tonight, I mean, when are you going to hit the price? You're going to hit the price when there's nobody around to challenge you. And that's what I see on on this Friday night. And that's what we see, I think, sort of towards the close of every session. In the hope that what happens is that the physical markets don't bring the price up too much overnight. And if you can ratchet it down just on futures that way, then your year-end book positions on your shorts is going to look very good. And I think that is why this quarter end, I think, has a lot to do with the weakness in the price of silver and also gold for that matter. And also, if you look at the platinum group metals, I mean, palladium a couple of weeks back was trading over $900, and now it's back to about, what, 817, 818, something like that. Yeah, it's about 808 this evening. So, don't tell me there's suddenly a new supply of palladium in the world. There isn't. It's South Africa, which is crippled with industrial disputes and lack of water, lack of electricity, and Russia. And guess what? We don't like Russia. We're banning them from doing this, that, and the other thing. Do you think they're going to supply us with lots and lots of lovely palladium? No, these markets are really, I mean, they are ignoring fundamentals completely. And I think, just sort of on a personal note, I'm, in a sense, I'm not really, I have desensitized myself, if you like, to these market moves, really because I know the whole thing is a bit of a charade. I don't trade gold and silver as such, but what I do is I take a long-term value judgment, and I can tell you that for my grandchildren I have bought more sovereigns, which are sort of roughly 1/4 of an ounce of gold, which I will give them, and they will have those sovereigns, and they will be under strict instructions that they've got to hang on to them except in the direst of emergency until they're 18. I guess that it will be the best investment I could possibly give them.
I don't think you can go too wrong there. I like that rule, too, to require them to hold it at least until that age.
Well, it's quite, I don't know how it works in America, but it's quite common over here that, if you leave a legacy towards for grandchildren, if you're alive when they're 18, fine. But if you're not, you wrap it up in a trust or something, a bare trust, and they can't access it until they are of age, and that way, they don't go and snort it all in coke or something, or you hope not.
It brings to mind a commercial that's running right now here in the United States, Alasdair, that I can't even remember what food product that they're selling for $1, some fast food chain, and they're showing an old grandfather that has a silver dollar coin, a U.S. silver dollar, and he's about to pass it on to his grandson. And then he's telling the stories about he got it from his father, who got it from his grandfather, and then he sees the sign for a sandwich at $1, and he goes in and buys a sandwich instead. So that's the mind frame of MSM of.
That is a very sad story. It really is. I'm going to cheer you up with another story. I first went to India in 1965, and at the time the price of gold was about 160 rupees an ounce. Today, well, it's been up to, and I suppose with the premium, it's not too far off 90,000 rupees an ounce. Now, you can understand why it is that the working classes and the middle classes in India, when it comes to the family pension fund, it's always been gold. Why? Because nothing else performs like it over a long period of time. You don't have to be clever. You just quietly tuck the stuff away, and every time there's a family celebration or something, you buy some more jewelry, gold jewelry for the wife. Markup on making jewelry is only about 10%, by the way. They live round gold as their pension fund, if you like, the family pension fund. Of course, the great thing, the government can't really get their hands on it, which is another reason to do it. And I think these guys are pretty wise. And that actually is an Asian approach to things. It's not just India. If you look at Turkey, the Turks love gold for exactly the same reason. They haven't just seen the Turkish lira sort of decline like the Indian rupee has. They had seen it collapse. They knocked 6 noughts off it in 2004, so that 1 million lira became worth 1 lira today. So you can see that the cumulative effect of currency inflation in Turkey has driven everyone into using gold. So that's why Turkey is a center for distributing gold in the Muslim world through Asia Minor and going into the various Muslim countries, spreading into the old Soviet Union, the Tajikistans and all the other stans, those states, and Afghanistan, I suppose, too, to an extent. The point is that in Asia, you've got around about 3.5 billion people. These people are no longer subsistence farmers. They are now increasingly employed in factories. They are becoming middle class. They are getting the skills to improve their economies, and they are savers. And the Chinese will put aside 40% of their earnings in the form of savings. Now, a lot of those savings are pretty duff, like, you know, who wants another apartment in an empty city? But, you know, gold is part of what they do. And for us in the West to ignore what this demand is doing to the overall shift, if you like, in gold ownership around the world, I think is very, very foolish. And that's basically what the Western financial system is doing. It's in denial, if you like, over gold.
All right. Well, I think that'll be a good place to wrap here. Again, as we've mentioned several times throughout the show, we'll keep our eyes on the market Sunday night, particularly in silver. We do have a risk for some further downside. The one positive thing for silver is gold still has been holding strong above 1,200, so we may not see a silver test the $16 level unless gold does early next week trade down towards that 1179 bear market bottom support, and if it were to break through that, things could get ugly quickly for the metals, particularly silver. But so silver does have that positive for it, that gold has not broken down yet to new lows, and as Eric mentioned, the COMEX close just above 18, but the access market, we are closing with a 17 handle in silver. So we'll keep our eye on the overnight futures trading on Sunday night, as that is one of the choice times of the cartel to throw down the paper hammer. But to Alasdair, once again, it's been a pleasure. Thanks for joining us on such an interesting day in the markets here.
It's been very much my pleasure, and thank you for having me on.
Anytime. We always enjoy it. So for Eric Dubin and Alasdair Macleod, this is The Doc. Thanks for tuning in to the SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.